Good evening, everyone, and welcome back to our monthly webinar series where we share our equity market outlook and provide an update on our strategies. So, it's a pleasure to introduce today's speaker, Mr. Aman Chauhan, who is a senior fund manager at Abacus. He brings over 17 years of experience in the investment industry. Before joining Abacus, he managed both local and offshore portfolios at Reliance Asset Management. And his exposure has given him a strong regional and global perspective in his investment approach. Academically, Aman sir holds an MBA in finance from KJ Somaiya Management Institute and a bachelor's degree in commerce from Mitibai College. With his depth of expertise and proven performance across diverse strategies, we are excited to hear his insights today. Over to you, Aman sir.
Sure. Thanks, Aishwarya, and good afternoon, everyone. It's challenging times, uncertain times, and hence uh, let's be very relevant. Let's be very clear as to what we want to discuss today. It's more of a market outlook. So we all know the uncertainty regarding Middle East crisis that is going on has impacted the market. So we'll discuss more of that. I'll be as practical and as brief as possible as to what could be the upsides as well as the downsides on from the situation. Right. So before we start the call and get to the specifics, let's get some background. This is what Indian markets have done in the calendar year 25. And if I tell you in absolute terms, Nifty has delivered 10%, which as such is not a bad number, especially coming that it is on the back of 3 good years of very strong performance. But on a relative basis, if you see most of the other emerging markets, they're all 20% plus. So this is where the issue is. Absolute return is still fine, but relatively, India has underperformed most of the peer groups or emerging markets in CY 25. This was India's worst relative performance in, say, almost 20 years kind of scenario, right? So this is where things stand today. This is the backdrop. So on an absolute basis, we are still fine, but on a relative basis, we have missed out. So far, in the first 2.5 months, this is how things look like. On a relative basis, also again, India has been on the receiving end. So we have some markets like a Korea or a Taiwan market, which is beneficiary of the AI trade, which is beneficiary of the semicon, or where you can say the crude dependency is the minimal. Those markets continue to do well. India has significantly underperformed because of our high dependence on crude, and that is where the issue has come, right? As we all know, Middle East. Uh, why is this such a big issue? This is such a big issue because almost 90% of our crude requirement is imported, 50% of our LNG is imported, and almost 70% of our LPG is imported. And bulk of this comes from the Middle East through the strait where we see the issue coming. In fact, 90% of the LPG comes through the strait, right? And this is what our storage capacity is, right? For the LPG, it is 15 to 20 days. For LNG, it is less than 5 days. This is the official number. Maybe it could be slightly more. And for crude, it is almost kind of a 1.5, 2 months of reserves that we have, which is not a very high number versus a developed world like a US or a Japan, which has like 6, 7, 8, 9 months of reserves. So this is what the background is, and that is the reason our markets have been, we can say, significantly impacted or more impacted, because this is where the dependency on oil lies. Right now, we all know the oil hit a high of $120-$125. It has traced back. What is the scenario now? So what we see on the media is this blue line, that crude, which used to be around $60 shot up to a high of 100, cross 120 intraday, and this is where it is. But what we are all discussing is just the spot. Nobody buys on the spot unless you need the delivery in the next 1 day or 2 days or 3 days. People, especially trade between countries, happen at forward rates, happen at long-term rates, which are significantly lower than the spot rates. And as we speak, the 1 year forward rate is around 80. So yes, 60 has gone to 80, but it is still lower than 100. So don't get too carried away with this 100 number that, oh, crude has crossed 100, 120, or tomorrow it can even go further high. What we have to focus is on long term, and this long term is also if we contracted today, what you have already contracted all these years has to be delivered to you at this rate, right? So this is where it is. Yes, situation is you can say worsened, but it is not as bad as what we initially think when we read media reports. So this is the first point that I would like to say. Besides oil, India has a large trade relationship with Middle East. It's almost kind of a 180 billion dollars kind of trade relationship that we have in Middle East, and also a good amount of 30-35% of the remittance that India receives from the NRI community comes from the Middle East, right? So any disruption in that country or in that region will have various impacts beyond just the oil, right? So this is also something that one needs to be taking care of. So this is the two, you can see the direct impact that we see. This is the India's dependence on this trade, which is basically LPG and you can say bitumen, which is fine. We can live without it for 2-3 months, but not with LPG, not with crude oil LNG, and that is where uh, the dependence on the Strait of Hormuz lies. So while we're discussing all this, we also need to take in care in mind that as things stand today, the situation is much better than what it was, say, a week back or 10 days back when things started to worsen out. Iran reportedly has allowed Indian ships to uh, go through the straits, and the first LPG container, I'm told, has already hit the Mundra port as we speak, and others are on the way. Right, so we don't know the actual numbers as to how many containers or how many ships have crossed the strait, but for sure the first one has already reached Indian shores, and the others are on their way. Right, if this thing sustains and continues, then I think it's not going to be a major crisis for us. What is the crisis that we are talking about? The crisis we are talking about is what we read in the media that we are short of LPG's cooking gas. Industries have been told not to that their supply will be resumed. Many industries have stopped production, like tile industry in Morbi, some of the other manufacturing companies, glass industry, they all stopped production because the gas supply to them has reduced. Why is that reduced? Is because of this reason that the government of India has a stated gas priority allocation, right? And this, what you see on the screen, is the stated policy of the government, which says that the biggest priority in case of a shortfall is that 100% of priority sector one will be first delivered, which is basically your domestic LPG, your domestic gas, cooking gas. The second priority is transportation. So the CNG that we get filled at the petrol station is the second priority. The third priority would be key industries like fertilizers, which are also big consumers of gas. And after that, we have the industrial and the commercial users where the gas supplies got impacted. Why is it got impacted? It is not that we don't have gas. We have gas, but we don't have a high reserve of gas. And since we are uncertain of the availability of future gas, we, as a precautionary measure, stopped or reduced the gas availability to the industry so that we have more buffer to give it to the priority sector number one and two in case it is required. So it is not that we are out of gas, yeah, but we don't have a very high reserve, and hence the priority has started where the first thing to get impacted was the industrial users, where we can live without maybe a week, 2 weeks of without gas, your production gets impacted, but that's fine in the bigger picture where you don't have gas even for cooking, right? So obviously, this news has led to hoarding of LPG gases. It has led to hoarding at various levels. People want to, you can say, keep the gas resources with them as much as possible, and hence demand is also suddenly shot up, and then it's a mismatch of demand and supply. With the supply resuming, I think things should get back to normal soon, if not immediately, maybe in a week, 10 days. And that is something which is a very good sign. Then the issue remains as to the price. That yes, we have started to resume gas. Availability is not a problem, but at what price? Already we are seeing a small price hike in LPG cylinders. Petrol, diesel prices are not yet touched, but they can go up. And if it goes up, then what happens? And then what is the impact on the economy and on the companies? Now, the impact on these companies is varied, because if you have to ask me, is there any sector or company that benefits? I will say out of 100, only five companies would benefit, or 5% of companies would benefit from a high crude price or an oil price or a gas price. Handful of companies, ONGC, Oil India, to some extent, because of the refining margins, HPBP also indirectly, you can say, gets positive impact. But 90-95% of all industries get negatively impacted, because crude oil in some form or the other would form as the base or the starting point, or you can say uh, the building block for most of the chemicals, for most of the raw materials that the sectors consume. It is almost impossible to directly analyze what could be the impact on various sectors, because you obviously don't know how and in which form this can get impacted. For a simple reason, I tell you that there's a company which assembles ACs and washing machines. Now you'll feel that if you're just assembling an AC or a washing machine, which means you're getting components and you are assembling those components and making an AC. But even that company got impacted, because to assemble, you need to weld, you need to solder, and for the welding machine, gas is used. Or even to produce metals, you feel if you have to produce steel, you need iron ore, you need coal, you need coking coal and a blast furnace, and to you can say start producing steel. But to fire the gas furnace or to get that required temperature, you require gas, right? And the gas is not there, then even the steel production gets impacted, right? So there are very few industries which doesn't get impacted because of gas, and hence it is very difficult to say that which industry will get impacted in which way. But broadly, you can say that 80 to 90% of the manufacturing sector gets directly or indirectly impacted by the gas. So I think availability should not be an issue, but yes, pricing would be. Now, how much of this pricing gets passed on will determine as to what will be the margin pressure. For example, you have a raw material input of 100, your selling price is 200. If this 100 rupees becomes 120, and if your selling price becomes 220, and if you're able to sell at 220, then your margin pressure is zero. But if you're able to sell only at 210, then the 10 rupees is your hit on the margins. So how much of this can be passed on will all depend on company to company, sector to sector. But needless to say that yes, there will be a cost inflation. How soon will this get visible? Definitely not in the March quarter, because for the March quarter, most of the companies have some buffer, they have some inventory to use as well as to sell, and hence we are already in the mid of March. So the month of March might not see any significant or a big impact. The impact will be visible more in the first quarter, where we'll come to know as to what could be the margin issue. Having said that, what will happen when the first quarter results get declared is that if by that time the issue gets resolved, tonight, tomorrow, in a week's time, 10 days' time, the ceasefire gets announced, or at the ground level things get improved, then people will ignore this first quarter results and they'll focus only that fine, this quarter results are bad because there was a temporary disruption in the supply chain, which has now normalized. Crude went up to 80, 100. It has now come back to 70s or whatever the number is. And hence we have to focus on the current number rather than look backwards. And hence markets will ignore. The key point here is the issue should get resolved. Now it is anybody's guess as to when the issue will get resolved. As common sense prevails, what we can point out to is whatever is the data that we have. Also, we are not sure as to how good data we are getting, right? But this is what you see on the screen is what the current intensity of the issue at the ground level is. When it started in Feb, you see initially 400 to 500 missiles were getting launched on a daily basis. Almost 700 800 drones were getting launched, which has come down to 10-15 in the last few days. Dubai airport was closed, Saudi airport was closed. Today they have started their operations in the last few days. Yes, flights are not back to 100% normalcy, but now they're operating at 60-70% plus utilization. Right. So things have started to open up, which means that at the ground level, these countries or these economies also realize that yes, uh, they they can safely operate flights. Imagine a situation where you have a commercial flight and which gets hit by one of the drones, one of the hundreds of drones that is flying in that region, right? And that can be like a catastrophic kind of situation, which you can't even think of a effort of, right? But you're operating a flight, which means that you have your systems in place and you have some understanding in place that that is not going to happen, which means that the conflict from what it started today is at a significantly lower level than what it was. We all know Iran doesn't have the financial muscle or the military muscle or anything else to be able to win this war with America. And hence, it's kind of a writing on the wall that they have to give in. How badly they give in is what one needs to take the assessment of, and how soon they give in, right? And obviously, nobody would like to give in. So I think sooner than later, this thing will get resolved. If not, you can say completely resolved, but at least maybe we can have a ceasefire or something, which will be a big relief overall to the markets. Is markets starting to build this? I think so. It has started to build. Last 2 days, we are seeing some kind of buying activity coming in. We are seeing investor interest coming back, saying that yes, the worst is behind us. The day announcement come in, market will open gap up. I don't want to wait till that point of time. I can start accumulating now. I can start at least my first 20-30% of buying now, and you proceed with that way. And this is what I think has already started, which is visible in the last 2 days. Today and yesterday, we are seeing that kind of activity coming back to the market. It's not reflected in the index yet, but this is what we are seeing when we see the can say counters, or when we see the market in detail. Let's get into a scenario where this thing gets delayed or it gets prolonged the way the Russia-Ukraine happened. When Russia-Ukraine happened, we thought this will also Ukraine cannot sustain or cannot fight with Russia. This thing will get over in week, maybe in a month time, worst case 2-3 months time. But it's been years and the thing continues. The Russia-Ukraine issue continues. Two things happen in this scenario. One, after a few months, we stop discussing the issue because we get used to it. It's no longer a hot topic. And if not ignore it, we tend to overlook it. Same thing happened in the tariff scenario also. When Trump came in, initially, the first few months, we were watching Twitter, we were watching what Trump is saying. Markets were reacting to each of his tweets, each of his tariff announcement. After a month or so, markets stopped responding. Not just Indian market, even global markets stopped responding to his tweets. And they all said that let the final number come, then we'll see what needs to be done. But people stopped looking at the numbers on a daily basis. This has happened in the past also. This has happened recently also. And for this issue also, I think that is going to happen. But subject to, we are not a party to it. If you are part of to the Ukraine thing or the Russian, then it is an ongoing thing for you. You're not a just a spectator. Right now, indirectly, we are party to this whole issue because 90% of our oil comes from this issue. So if this continues for long, then what is the option that we have? This is what you see on the screen, the option that we have. You're left with the Suez Canal. So whatever comes from Europe comes from here. It gets passed on through this Red Sea and then comes to the Arabian Sea here. What is impacting here is the Iran issue. If this Iran issue stays close, then Saudi already has a pipeline which goes east to west. They call it as the petrol line, right? So if this is closed or it is not as active as it was before, this pipeline which is already operational can be utilized. Yes, there is certain limitations to using this pipeline because you need a proper infrastructure, you need a proper shipping line, you need a proper port, which is not yet fully operational or to the capacity at which this was, because bulk of the oil was flowing from the air, right? But if this gets completely blocked or significantly blocked, at least we have an option here. As we speak, things are getting better. Worst case scenario, if they don't get better, or in the interim scenario for a week or 10 days or maybe for 15 days, there's an escalation and this gets stopped somewhere, or there is some accident here, there is some damage here, then this is something that is already started and this route has already opened up in that sense, right? So uh, this is the worst case scenario, that we won't be deprived of the supply. Yes, the cost of the supply can be an issue in the near term, and this is how we are going to resolve this. If you have to look at the past, when certain events like this has happened in the past, how an Indian markets reacted, and eventually what has been seen, this is what the scenario is, right? From the Kargil conflict of 99 to the 9/11 terror attacks to the Iraq war to the attacks in India, the recent Russia-Ukraine issue to all these things, as you all see, immediate impact is significant. But during the war, not much of damage, or during the period of escalation, not much of damage that happens in markets tend to stabilize. And then you can see the returns after the CAGR return, which is when the market delivers after the event is over, right? Now, this returns are also different and also subject to various things, which is that the domestic economy should do well, right? You cannot have a scenario where a domestic economy doesn't do well. When all these things happened, there was not a direct economic impact. Right now, there is not a direct, but definitely an indirect economic impact that we are facing a higher inflation number because of higher crude price, which can impact margin, which can impact businesses, which can impact the overall profitability. Having said that, what the current issue is that we feel if oil stays at $80, this is what the maths is, this is what the economists across the country have been putting, that the GDP impact will be 0.3 to 0.4%. Now, from a 7.5, 8% growth GDP, if you share off even half a percent, 8 becomes 7.5 or 7.5 becomes 7. That's not something which is earth shattering. That's not something that is scary, or that's not something that means that we are in doldrums, right? So we are pretty much in that way well balanced because the economy is definitely picking up. If you see second quarter of last year, the GDP growth was 5.5%, which was like a 7 quarter low. And that was the slowdown period that India was facing. And we know that post that, government has proactively announced tax cuts, GST cuts, rate cuts, plus government spending is back, which was also one of the major reasons that the economy slowed down. And we are already back to 7.5 plus. So this is not a hope trade. This is not a hope that the economy will recover, revive, or it will start to do well. It has already started to do well, right? It's unfortunate that we were starting to do well. We had a relative underperformance. It was time for the relative underperformance to get reversed because things were getting better. And unfortunately, this Iran issue happened. As investors, what can we do? We can do nothing much but to hope that the issue gets resolved. Coming specifically to stock markets now, because of this, what has happened is that after a long gap of various months, we saw FI money returning back to Indian market in the month of Feb. You see buying here at 1.7 billion, which was like one of the highest in a year. And unfortunately, so far in March, in the first 15th of March, we have lost $6.3 billion. So the money that started to trickle, come back to India, seen the relative underperforming, seen the valuations coming back, unfortunately has gone off. This is what the second market data, this is what we discuss on a daily basis. Even if you look at the primary market, now obviously in the last month or so, the IPO market has dried up. There's not much which has happened in the month of March. Prior to that also, markets were drying up kind of thing. But you see, this number was always positive. So while secondary market was off, positive was the primary market. But since market has dried up, this primary inflow has also stopped. There are no IPOs coming in, not much of IPO activity, and hence for IPO investment also FI money has dried up, and this has dried up the liquidity in the market, and hence today the impact cost is also higher. A month back, if you had to sell 100 shares of certain company, you might have a 1% price impact. Today, to sell the same 100 shares, you'll have a 3% price impact, right? So that is what the markets are. When sentiments are down, when the chips are down, markets is irrational on both sides. And this is what we have seen, that the FI selling has resumed. How long this will continue, what this will happen, we also don't know. All we know is that India is not alone. In the month of Feb, when things were better, even South Korea markets, even Vietnam markets had negative flows. In the month of March, so far, except for Brazil, I believe even Indonesia, the FI figures are negative. Philippines, FI figures are negative. Even for Taiwan and Thailand, the FI figures are negative, right? So it's not just that the India has got impacted. Even regional flows to other emerging market in the month of March has got impacted. And I think this money will resume only when the things settle down, or at least look to settle down. One caveat here: if somebody believes that if the AI trade in US were to wind up, or if people in US starts to book profit, or they reduce the AI exposure and the money then can come to India because India doesn't have much of AI and we are already got impacted by the stock purchase. I don't think that's going to happen. Typically, when your house is on fire, you first douse your fire, you don't go out looking for a new house, right? So if US markets were to correct or the UI AI trade were to correct, FIs are not going to remove money from the US markets and give it to emerging markets. First, they'll seek protection, right? First, you douse their fire, then you make your assessment. Okay, how bad the fire has been. Can you repair? Can you renovate? Or no? Then you look around. Okay, now I need to buy a new house, right? You don't buy a new house the day your fire starts in your house. The same thing is going to happen if US markets were to correct for whatever reason. If the war prolongs, or if the data point there weakens, inflation there goes up, and the rate cuts which is expected in US don't happen, then the markets that then correct, then the Indian markets can also correct. We can be relative outperformers if US market were to correct say 10%, we might correct 5-6%, but yes, the direction is that if US markets were to correct, Indian markets will also correct, right? So it's not going to happen that if US market corrects, that money comes to India, or comes that money comes to this emerging market basket. No, it doesn't work that way. So in the near term, this is what the risk is, that if the oil stays higher than 80-85 dollars for longer, then the cost of crude gets impacted to us. Supply wise, I think things will normalize soon, but price wise, we need to have a better, you can say, crude price. Second, global markets can correct because of this global uncertainty. It's not just India, right? All other markets, Chinese oil also comes predominantly from this trade, and many countries, many economies are dependent, especially the Middle East is dependent on oil, right? So there are various other economies also which get impacted because of this. So we need to see that the global markets also remain stable. If not, we can have a near-term impact. The good thing is that domestic liquidity is strong. SIP flows into domestic institutions remain strong, and this has been the center stone or the pillar for the Indian equity markets. FIs has been selling for the last year and a half, but that selling is getting absorbed by domestic institutions, and that is the positive sign. And this data also suggests me that very likely, as we see at most of the years, March is the month typically where the retail interest in India or the HNI interest in India is at the lowest. This is a year when we are closing books, we are unwinding our trades, and April is when people come back. It can be that this year also a similar phenomenon can happen. And this is how things are getting panned out. So you see the blue line, this is how the FI outflows are, and you see this red line, this is where inflow is. And because of this, our market dependence on FIs has significantly reduced. Domestic institutions, we used to own, say, around 18-19% of Indian equity, today is at 28%. And from 22%, FI ownership is down today at almost 16-17%, right? So the FI dependence on FIs is also steadily reducing for us. If this blue line had been flat, then it would have been a crisis situation for us, but that's not. This blue line is strong, headed upwards, and it's staying here upward. And hence, even if this orange line continues to drift down, we are in safe hands. So that's the, you can say, positivity of the retail investor or the individual investor in India. And it's not a surprise because traditionally we have been heavy, you can say, asset buyers than financial asset buyers, and that scenario is changing. Plus, with gold getting repriced, there's a wealth effect in India, right? So if you had say 100 rupees of gold and say 10 rupees of equity, then 100 rupees of gold becomes 200 rupees, right? And your equity is 10, has remained at 10, and maybe has become 12, right? So then what do? Your exposure to financial market has even come further down, and you have a decent gold, right? So you can pair some of your gold, you can book some profit in gold, you can switch some liquidity from gold towards equity market. That is also one of the reasons why we are seeing that this remains strong, because people are gradually coming into financial assets, and that is the phenomenon that we are seeing. Hence, I'm not overly worried if this FI selling, which is resumed here, continues for say another 15 days or a month or 1-2 months also. We are well positioned to absorb that. The main thing is that sentiment should resume, sentiment should again come back, because this is what the single biggest factor is which drives the near-term stock market performance. If things were to resolve, I think from April onwards or maybe end of March onwards, markets should tend to stabilize and should tend to form a bottom kind of scenario and then start to look up. It might not be a V-shaped recovery, but at least we headed towards a decent high single digit or a double digit return kind of scenario, because that's what the earnings growth of India is. Valuations are closer to the 10-year average. Not much to say that what used to be 20 is now 18. Uh, individual stocks are even lower. Mid and small cap index, as we all know, have corrected much more in the last 12, 15 months versus the large cap index. So the valuation there are even much more supported than what it was. And hence, I don't see any reason that once things resolve, why shouldn't FI money come back, or we see a higher domestic money coming in and market starting to perform. In this whole scenario, what happens to rupee is also something which is interesting, because that also is a big sentiment driver. INR, till you can say 6 months back, was amongst the better performing currencies. It will be in the top quartile. Last 6 months, it has not. In the last 1 year, it has lost say 4%. Right. In the last decade, on an average, we have depreciated 2-3%. So far, we have depreciated 4%. It is not that something that it is like majorly, but yes, from a numbers perspective, it is a big number. That 90, 85 has become 92. Now, where is this 92 headed? I think if crude oil remains even higher, and there's not a major risk to this number, 92 can stay around this 92, 93 band, or maybe even go to 90, 91 odd levels. The major risk to INR comes from dollar appreciation. It is not going to be INR depreciation that's a major worry, because we have enough forex reserves. We can handle the crude shock. We can handle to a certain extent things are, and I'm I cannot predict things, but common sense says that things should get resolved sooner than later kind of scenario, right? If not, then obviously, as I showed you, what the alternatives are. So in that scenario, the risk to the rupee only comes if the dollar strengthens. So the dollar index, which a month back was around 97, 97 half levels, have come back to 100 odd levels. And that is what has triggered this 91, 91 half rupee going to 92 half, right? So it was not INR depreciating, it was more of dollar appreciation that led to this. If this dollar index has to move from 100 to 103, 104 levels, which was the level when Trump got elected a year back, then we can lose 1 or 2% only versus the dollar. Maybe with other currencies, say euro, pound, or other major currencies, we might not lose. Only versus the dollar, the headline number can see 93, 94 levels. So that's the near-term risk we carry on the currency front. Only if the dollar appreciates is what we feel. Otherwise, we feel we are pretty comfortable on the currency front also. All this obviously is under the assumption that things get resolved soon, which to me looks like, because that's what I highlighted to you. This is where the situation is. Iran is not in a capacity to handle this. We all know Iran is not alone in this. It has indirect backing of its neighboring countries, which could be helping it with, we can say, arms, ammunitions, maybe currencies or something. But how long that strategy also works, we also don't know, right? So, if that is the scenario, then soon US also would have to take a step back, because US market itself is facing decently high inflation because of the tariffs that is coming in, right? So net net, this is what the background is, that expect a resolution to come in soon. Valuations are decent on a relative basis. In fact, India has become much better. We are now lower than the 10-year average. This is the average India's premium over the emerging markets, right? The premium was pretty high during the 22, 23, 24 era when Indian market did well. We are among the top quartile performer. That is now today below the 10-year average. So we are now at the premium levels that we have seen over the last 2 decades. Like from, you can see 10, 15 years, this is where the average premium is. So it's not just the absolute valuation, even the relative valuation wise, India is now well priced, I can say. And hence, from a fundamental perspective, it's much better. What have we done in these uncertain times? We have used the cash that we have in various portfolios to deploy wherever we had cash in excess of 20%. We have got it brown down to 15%. Where it was 15, we have got it down to 10. For all our new clients, they will be holding 10 to 15% cash. We are positive in the markets, but gradually deploying cash. We are not aggressive, right? So we are cautiously optimistic would be the right word, or positive in the markets to get the cash deployed at these levels, because at various pockets valuations are now compelling. But yeah, we are not aggressive either. Just because we have also seen the Russia thing that we thought so, maybe the war will end in weeks or months, but it has taken years now, and hence we cannot be blind to that fact. But if you have to ask me, my gut feeling, I feel this is going to be different than what the Russia-Ukraine scenario is, and hence we are positive from that sense. We are deploying cash. We are buying more of pharma. We are buying more of metals. We are buying more of manufacturing, local manufacturing, more of cement. IT, we are still neutral. We held our exposure to IT 6 months back, staying there, even though prices have corrected. We're not buying more of IT at these levels, but buying more of the other sectors that I mentioned to you. So that's broadly what has been our response. It's challenging times. You need to be, you can say, flexible, at the same time agile to, you can say, react to the events that when they unfold, and that's what we are doing in the midst of the current scenario. Uh, these are all the broad market positives that we are hoping would tend to get reflected in the equity markets, not just the US. We have signed some almost 17, 18 FTAs over the last 12 months, with US also finally get resolved at the 18% number, which was a relatively better number because all our other emerging markets were on the 20-25% tariff mark. But anyway, that has now all come down to 10% because of the Supreme Court ruling in US. But that's where things stand today. The things were getting better, not just economically, local economy, but even India's position in the global trade. And unfortunately, it happened. So, but fine. Let's hope things get better as much as possible. This is what the budget was, where we saw an impetus towards capital building. So these are all the, you can say, 1 year, 2 year positives. But on the near term basis, this is what the scenario is, that we can sustain higher crude price for maybe a week, 2 weeks, 3 weeks, post which things will get to uh, get difficult for us to maintain then the margins. Supplies will resume, but margins will get impacted, and that would have some impact on the equity market also. So this is what the scenario is. I'll pause here. I'll We can open up for Q&A. I'm sure you guys would have some queries regards to the market or something. We'll not discuss stock specific names here, but anything besides that, Aishwarya, we can now open up for Q&A.
Yes, sir. Sir, can you give a general view on our current PMS strategies, all three PMS strategies?
So we have seen any new client that has come in the all cap or the emerging PMS would be having almost 20% cash as we speak. Any new client who comes in, 60 to 75% gets deployed in the next 2 to 3 days or in a week's time. And the balance money we hope to deploy as things unfold. So that's the, you can say, overall trend that we have in the PMS. For the ADAS PMS, we are almost 90% deployed, but that's a very disciplined portfolio that we have created, a 40 stock portfolio across the four segments of the market, right? And hence the deployment level there is on the higher side versus the other two PMS. From a performance perspective, all cap continues to do well in the near term. 3, 6 months, 12 months, we are doing well. We have recovered decent amount of underperformance that we saw the last year. Emerging fund is still challenging because the mid and small cap is not still performing in India, but we are fairly confident that once mid and small cap starts to perform, which can happen anytime from April onwards, we'll be able to generate enough alpha to get back on tracks. ADF fund is also tracking similar to what the all cap fund is, and that we have seen recent recovery there also, in spite of the current market volatility. Sectoral preferences, I told you, stays same for all the three strategies. So buying more of pharma, buying more of domestic manufacturing, buying more of cement and other sectors. IT is neutral. Banking is neutral. On the fringe, we have booked some profit on the banking sector. And yeah, that's broadly what the sectoral preferences are for all the three PMS.
Okay. The next question is one of the slide one of the slides shows India is relatively cheaper versus the emerging markets, yet it is not driving the returns. What are the other headwinds besides the relative valuations that is holding back these returns?
So India is not Uh, cheaper. India's premium now is less than the 10-year average. So this is India's premium. So India is traded at a premium between 30 to 80, 90% versus its relative emerging market peers. So this is not gone to a discount. It's not cheaper, but yeah, the call in India always is whether we are more expensive or less expensive. India never treats cheap. And we all know the reasons why. We can spend days discussing the positives of India, the demographics, under penetration, Modi factor, longevity of growth, and whatnot, right? So uh, it's always less expensive or more expensive. Today we are less expensive than what we were 6 months back, 12 months back, or 18 months back. So that's the call that we have. Besides this, the pushback for India is oil, right? We are the highest dependent on oil, and that is where the biggest issue is. If you see, which I showed you in my first slide, 90% of our crude oil is imported. This is where the biggest pushback for India. And this is in spite of the fact that today 20% of the petrol is getting blended with ethanol, which is all domestically produced. So had the Modi government not introduced the ethanol policy, then we will be importing at least 20% more petrol than what we're importing today. That would have added to this, in fact. So in that way, uh, we are impacted, but that's where the negativity of Indian comes in for a foreign investor.
The next question is your views on large caps versus mid caps and small caps.
So obviously, in the near term, when markets stabilize, large caps tend to do well in the near term. But I see pockets of valuation comfort emerging in mid and small cap also. So today, if you ask me, we have not changed our strategy per se. So even in a flexi cap fund where we have a 40-50% large cap and say 30-40% mid cap, incremental money is also flowing in a similar ratio. So it's not that incremental money is 90% large cap and we're not buying mid caps or we're buying only mid caps. We are keeping it balanced. Near term, large caps tends to do well. When large caps do well, markets stabilize is when the time mid caps start to do well. But instead of looking broadly from a large cap versus mid cap scenario, for us, the call is always that within large cap what makes sense and within mid cap what makes sense, right? So it's not just a cap story. That whether you're in large cap or mid cap, you should be in the right cap. Whether it is large or mid, you should be in the right stocks, and that is what the focus for us always has been.
When can we expect the FPS to come back and invest in Indian equities?
Once the crude price settles, I think FI money should come back. The way we saw in the month of Feb, FI money started had resumed to come back, right? Because economic growth is picking up, things are getting better in India. Because of the Iran thing, it again turned negative. Once this Iran is resolved, this 1.7 of Feb should incrementally start to come in. So as soon as the crude price settles or the issue gets resolved, I think FI money should start to come back.
The next question is if the war prolongs, does the risk reward for equity changes, as this case is different from the Russian war?
If the war prolongs, the risk reward for Indian equities changes in the near term. Yes, it just changes. It's not that the war will not have any impact, because if the war prolongs, there will be a premium to the long-term average of crude. So it's not going back to the $60. Maybe it settles between 70, $75 or $80, something like that. Right. And in that scenario, we will have the impact which I've already discussed. Right. So in that case, the near term, uh, the you can say attractiveness on Indian equity markets or corporate earnings growth gets impacted, right? So that extent, things get impacted. But over the long term, neither the war is going to run for very long. And if that is the belief, which is our current belief, then equity market should continue to deliver the kind of returns the it has been giving so over the last several years. So from that perspective, the equation doesn't change. In the near term, yes, the equation can change.
Your views on the IT sector.
We are neutral on the IT sector. We have reduced over the last 12 months our IT sector exposure. Stocks have corrected post that. Valuations now are compelling. But we are growth investors. We are not pure value investors. So it's just because Infosys is now at a much better valuation than what it was a few months back. It's not a reason to own it. We want to see growth coming back. We are not in the camp which sees that AI will disrupt the business and we will be significantly impacted. What can get impacted is the growth rate and hence the derating that has happened in the IT sector. And we are also in that camp that bulk of the derating is behind us. We are just waiting for a reason to buy. What can happen is because IT is also fallen tomorrow, if the markets were to bounce back 5 or 10%. Maybe IT will also bounce back 5 or 10%, but the other sectors can give you maybe 12, 13, 14% return. And that is the reason we are neutral on IT. We are at these levels, we are not trimming our position. We did that 6 months back, but at the same time, we are not adding to our IT exposure as we speak.
The next question is your views on banking and finance sector.
So after a long gap, the banking and finance sector has done well, and last 12, 15 months, they have been, you can say, absolute as well as relative outperformance. I see this continuing. We are equally positive on banks as well as non-financial, non-fund based financials like AMC companies, broking companies, wealth management companies, stock exchanges, right? So we have some exposure in these sectors also. So both the financial sector, which is banks and NBFCs, as well as the non-fund based financial is something that we are positive on. And it's reflecting our current portfolio and expect that to continue. Near term, this is the most liquid sector. This is where the maximum FI ownership is. So if they have to sell, this is where the maximum liquidity is there. Hence, there is some pressure on the financial sector over the last, you can say, 2, 3 weeks when the market has been volatile. So that can continue in the near term, but overall, view on financial is positive.
Can you share a small brief on the USD INR depreciation scenario?
I explained that from these levels, I don't expect INR to depreciate on its own. It can depreciate only if US appreciates. The dollar index, which was 97 a month back, has come to 100. If it goes back to 103, 104 levels, which was the level when Trump got elected a year back, then we can see another 2 to maybe 1, 2% or maybe 2, 3% of further INR depreciation. But that will be specific to dollar. We won't be depreciating against euro, pound, or other currencies. So it's more of dollar appreciation than INR depreciation risk that we have today.
Your views on the data centers as a theme, as a sector.
It's a high capex sector. Bulk of current global investment is getting towards that. It's not a hype. Valuations could be on the higher side in certain pockets, but it's like writing on the wall. The way we have EV, we have data centers. The demand for data centers is going to increase because the kind of data we are generating, the digital data we are generating on a daily basis is humongous. And with AI coming in, this data needs to be processed, and hence you need more speed, more capacity, right? From a stock market perspective, India doesn't have much of stocks which are direct beneficiaries of data center. We are building some data centers, Adani Group, Reliance Group, somebody or the other has been announcing that we want to set up data centers, but these are small in the overall context of things, right? So there are not much of direct place to play on or to invest to capitalize on the data center thing. As of now, it remains more of a global thing than India. The data centers being set up in India is predominantly for capital usage, though the government in the budget has announced you can say benefits for data centers being built in India for global use. As of now, at the ground, we are seeing whatever is being built is because of the government regulation that Indian data should stay within India. It should not go beyond India for obviously security and other reasons. So that is what is fueling the data center demand in India. It's not the global demand that is coming to India.
Beyond the current geopolitical issues, the sectors that could be looked for fresh investments.
We already discussed that we are positive on pharma, we are positive on metals, we are buying more of domestic manufacturing, cement. These are some of the sectors where we are doing incrementally better versus, say, consumer or an IT or say oil and gas or say even chemical sector where the uh, near-term geopolitical impact could be higher. IT, there is no impact, but for other reasons, we are not uh, very positive on IT. But clearly, oil and gas, chemicals, your commodities, bulk commodities, this is segments which can get near-term impacted because of higher oil.
In case of fresh investment, what can an investor choose? Diversified alpha PMS versus emerging opportunities, considering the current scenario.
It depends on what the investor appetite is. You have to assess your own risk reward. You have to assess your own liquidity, your own diversity. If as an investor you have a 3 to 5 year view, you're okay to handle the near-term volatility, then emerging fund is a dedicated mid and small cap portfolio. It is pure simple maths that from a small company from a low base can grow faster. If it grows faster, it gets a better multiple and a better return. But yeah, it's just being a smaller company, it is more volatile also. If you are not so keen to witness near-term volatility, need a more balanced portfolio, then ADF is better than emerging. If you can handle the mid-cap volatility in the near term, it's not risky. Risk is the same. It's just that it is more volatile in the near term, then emerging is a better option.
Your views on the emerging markets.
Emerging markets is very diverse. After a long gap, China has started to perform, Korea has started to perform, Taiwan has started to perform. The traditional emerging markets are still okay. They are struggling along with India. So it's a can say it's a diverse view. There is no clear view. Uh, Obviously, Taiwan and Korea are happening because of the AI and the digital theme. Other markets are not doing so well. India has signed FTA with the EU, with UK, with US also now is almost back to status quo kind of a scenario, right? So we should start to do well once global trade or global demand resumes, and so should be the other emerging countries also, and that should reflect in their markets also. Overall, expect emerging markets to do well versus developed markets, but in the near term, because of this AI technology or the large IT companies being predominantly out of US and Nasdaq listed, your Amazon and your Meta and your Tesla and the other companies of the world, Nasdaq can continue to do well, right? So besides that, within emerging market, I think India has been for long amongst the top quartile performers. Last 1 year, a year and a half, it has not been. uh, I don't see any reason why it shouldn't get back to the top quartile.
Okay, so we've covered majority of the questions. This is the last one. Your views on the semiconductor and defense as well as FMCG sector.
Semiconductors are not many companies, or rather, they're not companies that are directly there to invest. So it's not. It's just a theoretical discussion. Nothing that we can do. Defense is definitely a multi-sector opportunity. Not just because of this geopolitical situation. Even before that, the mega trend is that we were importing after oil. The biggest import bill is defense. So we were importing defense. We don't want to remain dependent on imports. We want to now start manufacturing, rather started manufacturing in India, and that is what the biggest opportunity is. Stocks had gone expensive. 50, 60, 70p was on the higher side for a sector that is dependent on government in a way. Uh, Valuations have come off in certain names at a decent price. This is a sector worth looking at. View is positive, but at a price. So we don't see much of different exposure in my portfolio because of valuation. I like the sector, but not at the price that it is. If the price becomes reasonable, we'll be definitely adding more exposure on the defense side. FMCG, uh, we have valuation discomfort there. Growth rates are picking up. We prefer more of consumer discretionary than FMCG because that's where on a low base things can really pick up. Staples or the standard FMCG sectors, they're still 50, 60p for a 10, 12% growth, or in some cases even lower than that. It doesn't make risk reward attractive for us enough to look into that.
Okay. Sir, we have covered the questions. Thank you for those insights. Any concluding remarks from your side?
The remarks is the same. As investors, we are bound to stay hopeful, bound to stay positive. Let's hope that it's sooner than later where the issue gets resolved. And if that's the scenario, then Indian market should come back from where it was to being among the top quartile performers in the emerging market space. This is what I hope. So domestically, we're doing well. Growth rates have already picked up, should sustain at these levels. Government is very focused. They are very clear. They'll do whatever possible to see that India has a 7-8% growth rate, and that is where I think bulk of the interest is that if we go back to the old growth rates, then the investor interest should also start to come back. And that's what it is. Oil also, I don't think supply is going to be an issue soon. The price at which the supply resumes is what the key parameter is where we need to be focused on. And let's hope that the long-term average of 60 $70 stays in the long term. Near term, there could be disruptions. And um, we all know Iran can't sustain this for long. So let's hope for a early resolution there. That's broadly from our side. Uh, thanks again for joining us today afternoon for this. We hope to connect back with you soon, maybe once the issue gets resolved, or if not, maybe still in the next month or a month after that, we'll have another similar sessions to give you a brief as to what the market looks like and what we are doing. So that's all from us from the Abacus platform. Thanks everyone for joining us. Have a great day ahead.